All right, today we are talking about that moment when you find out that you are expecting an inheritance. And maybe what you're receiving is a surprise, or maybe the fact that you're receiving anything is a surprise. This might be from an immediate family member or a long lost family member, but we're going to talk through some of the key points to consider when you all of a sudden find yourself in a moment where you're anticipating an inheritance. So, Jeremiah, let's get started. What should we start with?
Yeah, this is a whole segment of clients that we work with that we also often call them survivors, whether it's the kids of the next generation, whether it's a spouse, and maybe one spouse was managing a lot of the assets and now the surviving spouse is taking that on. But it's a moment where they're taking on new assets that maybe open new possibilities or maybe come with new responsibilities or new struggles. And often, kind of what we're going to walk through is, I think, starting with the emotions of it. You might be feeling the loss of a family member and feeling, what's my role here? So even before you get to the inheritance aspect, feeling, how do I need to support my family? Or how do I deal with this emotional loss? We had a situation years ago where someone said, I would much rather have my dad than have this money. And I think it was a really honest moment of, they weren't looking for the money. They wanted the relationship with their father, but because their father passed, they inherited a fair amount of funds. And it almost became not guilt is the wrong word, but something where they didn't really want it. They didn't want to do anything with it. They didn't want to think about the money because it equated losing that family member. And I think that the first step is probably the emotions, just acknowledging what emotions someone is feeling, because that's going to impact how they relate to that money.
Yeah. And I would say the next step, because you're right, there can be a wide range of emotions that accompany the death of a family member. As a financial planner, we're oftentimes towards the top of the list when family is ready to reach out and inform us of a passing. And if there is a financial plan in place, a lot of times there's this sense of urgency that we receive from the person that's informing us of the passing. And oftentimes, just to acknowledge kind of Jeremiah's point about those emotions, our response at that time is there's nothing urgent that's necessary. In fact, making urgent decisions is sometimes unadvisable in this moment, because take a moment to grieve and to understand what this means to you and your family members. But there's a wide range of emotions. And so I would say the next step, after just kind of acknowledging the emotions that you feel or the people that are close to you, is then starting to discover and create clarity around what role you play in the estate planning, as well as planning a memorial service. What role you play and what role others in your family play. Maybe there's already clarity that you have prior to arriving at this moment, the death of a family member, but maybe there's conversation that still needs to be had, or maybe there's new questions that come into play. And so again, I always like to say clear is kind, and I like to draw the family members together to discuss, either the delegation of tasks or just to have a clear assignment of roles, so people know when they need to ask questions, who they ask questions to, who's responsible for what, because there are a lot of details and next steps that need to come into play after the passing of a family member.
I like the way you said that, because it's kind of taking out the emotional, we have to do it all right now, and falling back into it. Okay, things need to get done, but let's get a family plan. Let's figure out some roles and let's do kind of a strategic process. I think there's a lot of wisdom in that, of not just being so reactionary. Because often in this, thing needs to happen for 20 days, for 30 days. There's time to really get your head around what's going on and then start moving forward with different activities.
I think it would be helpful to talk through, especially from your legal perspective, Jeremiah, some of the things, the key roles in the estate planning process, like successor trustee and power of attorney, and, kind of what are some of the changes that people can anticipate, and what are kind of the key roles of those positions?
So when someone passes away, whether it's a spouse or whether it's a parent, things that were active during their life, like powers of attorney, healthcare directives, HIPAA disclosures, things like that, those all go away. So those all end at the time of their death. But the things that all of a sudden come to life potentially are like the will. There's an executor under their will, but mainly there's the role called the successor trustee. So that's the person, if they have a trust, that's going to step into the shoes of the person who just passed away and kind of run the things, run the estate and run all the assets in the trust. So the successor trustee role is probably the biggest one that kind of takes charge once someone has passed away. And between two spouses, often it's the surviving spouse. Sometimes they may feel very equipped to do that. Others, they may feel very unequipped to do that. And they need family support, even though they're now the successor trustee and they have to make the choices. They need family support. So those are the key ones. That the relationships I think are important to bring in is things like an attorney, an accountant, an investment advisor. And I think the biggest piece of hopefully freedom for people out there is if you're the successor trustee, you're not on your own. It's not that you have to like magically know what to do or figure it all out yourself. There are professionals who walk through this every day. So getting a good accountant, an attorney, and maybe an investment advisor to kind of advise you on what's next. And ideally, you would already have those relationships, right? You would already have someone in your life that knows your finances, knew your spouse or your parent, and understands how all this is going to work. That makes it so much smoother versus having to get a team assembled for the first time, understand how either your parents or your spouse's assets were structured.
That point that you made is so important. If you are a successor trustee who is newly stepping into the role of trustee and administering a trust, you do not have to do it alone. You may have several questions, administrative or more on a broad sense of what the plan is going forward. You may not feel equipped or capable to step into that role as a result of those questions. You do not have to do it alone. And this is a moment to seek counsel from professionals in your life. And like Jeremiah said, you may already have those relationships, or it might be helpful to reach out to some. But people like a financial advisor, people like an estate planning attorney, people like a CPA at some point down the road, right? So that just can kind of walk you through what the requirements are and the details of what's included in the trust, because they're not all the same. Some are extremely straightforward and some are much, much, much more complex. So the point being, you don't have to do it alone and you don't have to have all the answers right away.
Yeah, that's great. So I think once you've kind of got through the emotions of it, you figured out your role, you probably got through the family grieving, hopefully some connections, hopefully some good resources. Now we're getting to the kind of the guts of what we're talking about today is you have an inheritance. There's some funds coming into your household that you didn't necessarily either expect or plan on, or you knew were coming someday, you just didn't know when. And I think the first step that we often walk through is understanding, what did you actually inherit? Like, what is actually coming to you? And that sounds like a funny thing to say, but if you inherit a house or an investment account or an IRA account, those can have very different tax implications. Those can have very different ways of turning those from what they are currently into usable cash. All of that has a very different structure. And so understanding, what is it that I actually received? And when it gets to you, what are the rules around that?
Right. So creating a list of what you actually received, right? Common features here are, it could be the benefit of a savings account, an investment account, real property, annuities, qualified or retirement accounts. There's all different types and characterizations of inheritance, and we'll go through that in just a second. And then the other thing is to have a clear list of who gets to benefit from these assets. So it could be you, or it could be a long list of beneficiaries. And to what portion. That's really a good starting point. And then let's talk through kind of just broadly speaking, the different types of tax characterization. So the one thing that I want to start with is the year that the person passes away, there will be an estate tax form. And I believe it's Form 706. You'll need to work with your CPA that will help walk you through basically the completion of their estate. So it's reporting to the federal government that this person has passed away. They retire, so to speak, their Social Security number. And if there's a trust account in place, that then becomes the now new sort of accounting code that the federal, I believe it's called the EIN number, that the federal government will now use to oversee for tax purposes, the management of these assets going forward. And so there is tax filing that is necessary in that first year of their passing. And then Jeremiah, do you want to talk us through kind of this idea of tax implications and cost basis?
Sure. Yeah, we're going to maybe do on a scale, the ones that maybe are the easiest to inherit and ones that maybe the hardest with the most rules. So starting on the easiest, if you inherited a stock account, just a good old-fashioned investment account from your parents, say, you're going to get what's called a step-up in basis. So whatever they paid for those stocks years and years ago, there might be a lot of kind of capital gains built up in that account. When they pass away, that cost basis comes all the way up to the fair market value, and all those taxes kind of wash away. So you may be inheriting this stock account, and your taxes that are built in there may be zero, depending where you're at. And that's something that you would then be able to, once you receive it, trade those stocks, turn them into cash. So that's probably the easiest to inherit. Next to that is probably real estate. If your parents had like a rental property, you get that same step up in basis, meaning all the taxes that kind of built up during their life, they'll wash away at their death. And then you, as inheriting the property, generally get it tax free. However, you now have to sell the property. So it's not quite as easy as it was with the stocks. You have to go through a realtor.
A little
It'll take some
less
time.
liquid. Yes. And there could be some increase in value even after the date of death. Realistically, on the date of death is not the moment to be dissolving of these illiquid assets like, property. And there could be actual, an art collection or cars or something else of high value. You're not actually going to sell it on the date of death. But what they want to do from tax purposes is evaluate the fair market value on the date of death. So up until that point, any of those gains, as Jeremiah was talking about, are washed away. There could still be some incremental gain or loss of the value of the asset between that and the date that you actually liquidate it. So there could be some minor tax liability. But for many, most of the tax implications in terms of gain are washed away at that moment of passing.
So good. So we have stock portfolios, we have real estate. Next in line, I would say, is retirement accounts. So like a 401k or a 403b, something that your parents might have had. When you inherit that, it's still a wonderful asset to inherit, and it'll get split and it'll become your account. But there's some rules with that. The first one being that money was never taxed during your parents' lifetime. So when you take it out, you're going to have to count that as part of your income. So there's a tax leak or a tax dynamic with that. The other aspect is under current laws, you have 10 years to get that money out of that account. And so it's a little bit of a clock that's ticking. And if you don't take it out year 1, 2, 3, 4, and you wait to the very end, you may have to take the entire account in 1 year and add that full amount to your earned income in the year. And for many people, that's not ideal. And so if you inherit a retirement account, it's still a great asset, but there's a little bit of nuance there that there's going to be some income taxes, very likely, and you kind of have a little bit of a timeline you have to follow. There's even some required minimum distributions along the way. And so if you inherit that type of account, it just takes a little more detail to know what you have.
Yeah, I was just going to interject that in the scenario that you were discussing, it was a child inheriting the qualified or retirement account from their parent. You could be a spouse inheriting the qualified account, and current rules allow you to convert that account into your name. And so it just essentially becomes your account. That's kind of the simplistic transfer of that qualified account. At the point in the future that you were to take distributions, it would be taxable as earned income to you, the beneficiary. So there's different rules that apply, whether or not you're a widow, whether or not you're a child inheriting the account, or in some cases, the trust can actually be the beneficiary of the retirement account. And that has a whole different set of rules. So it really matters who is named specifically as a beneficiary, because retirement accounts transfer according to beneficiary. So essentially outside of trust, not to be confused with when a trust is named as one of the beneficiaries, right? Because then the account can transfer into the trust. So it can get a little complicated. The other type of account I was going to bring up is annuities. And annuities are their own type of investment. And annuities can actually be pre-tax or post-tax investments. And so the answer to that in terms of tax liability, if you were to inherit them, is really it depends. It depends on what type of annuity policy the decedent had and whether or not it was purchased on a pre-tax or after-tax basis.
Yep. And I think those annuities, to your comment, Laura, they're just different. And it's hard to even generalize them of what options you might have, what tax impacts you might have, you receive those funds. So in my mind, go from stock accounts, real estate, qualified investments, and then all the way over to annuities of trying to determine what is it that we actually have. So once you've determined that, you see this cost structure, I think then it becomes, ideally for most people, not a question of what do I have to do today, but really some forward-looking dreaming of saying, what opportunity, what could this money do for me and my family? We've had clients who immediately think about quitting their jobs, and we've encouraged them to say, let's not make any knee-jerk reactions. Let's really consider, is this something that you want to be able to retire early and utilize these funds for that purpose? That could be a good purpose. Or is it something that is going to unlock maybe some financial security or some dreams that you had written off years ago that now become a possibility? But it takes some time to really unearth that and not just feel as a knee jerk. So just as a story, we had a situation where someone's parents died, they left a business. And the client of ours very quickly was like, I'm going to quit my job and I'm going to take over the business. That I think is the best idea. And we kind of encouraged them to try it out for a little bit, and they did. And for 3 months, they took a sabbatical from their job, and they did that and realized, I do not want to run this business for my life. I enjoy what I do otherwise. I do not enjoy this. And after a few months of testing it out, it became very clear to them they needed to move towards selling the business and continue their career. And once they sold the business, those assets really opened up some new avenues for them in the life they were already living, rather than detouring to a new career. And I think it's a hard moment because it seems like a great opportunity. It seems like this wonderful new adventure, but really deciding if that's your adventure or if the best opportunity is to really just liquidate that asset and add those finances to your current life.
Yeah. And I love that story because it also reminds me to make sure that there's a legacy piece, right? And an inheritance. And it could be the case scenario that you were very close or distanced from the person that passed away. But it is worthwhile acknowledging what sort of legacy was critical to that person in leaving. What was their mindset and their thought behind the funds that they were using? Maybe there was a vision. Maybe there was a charitable aspect to the type of account that you inherited. Maybe there was some other stated instructions in the trust that are specific, but maybe there's nothing. And maybe you're simply receiving these funds for your benefit or your household's benefit. And so I love to Jeremiah's point that oftentimes what feels maybe like excess or extra or a surprise or something you weren't anticipating, oftentimes recommend those who are inheriting not to make any sudden life decisions. To, first of all, the just account transfer and estate administration just takes time. So simplistically, from a practical perspective, it's helpful to give yourself time to let those funds actually transfer, let the tax dust settle, so to speak, so you know exactly what you've inherited in a net sort of manner, what this means to you. And then I think this is a great opportunity to retool and revision and say, is this going to have a dramatic impact on any of my life goals, my career planning, my retirement goals, my ability to donate to charitable organizations, my ability to bless my children? There are so many different outcomes that could come as a result of inheritance. And so I really encourage the best case scenario and the best financial plan is built when there's a clear personal plan. There's a clear vision behind what it is that you'd like to do with these extra funds.
And it's not uncommon the wealth of folks who will use some of the funds to really honor their family member, the person who's passed away, who they're inheriting from. And even when recently we have the mom and the daughter discussed taking this trip for many years and trying to figure out when to best do it, but the mom passed away. And so now the daughter is taking that same trip, in essence, in honor of her mom. And it was a really beautiful way to say, we're using some of these resources that they received in the inheritance to use them in a way that the person who is now passed would have really appreciated, really would have enjoyed. So I think that is a great way to use some of the funds or all the funds to really honor the person who you received them from. So I think this trip that they're taking, I think is a good way of saying, we would have done this together. Now I'm going to do this in their honor, because I know they were excited about this. I think it's really powerful.
Yep, I love it.
Wrapping up a little bit, I think that kind of the takeaway, the challenge to say, hey, if you found out you're inheriting something, first, I think acknowledging your emotions. You're very likely going to have some emotions, and not just to be driven by them, either the urgency to do something or the sadness of a loss, but to be strategic, to sit down and think through, I've had some emotions, now let's make a plan. The second, I think, is to look at what deadlines are actually urgent. This is where things like a CPA, an attorney, a financial advisor can be extremely helpful. They will help you say, yeah, these certain things need to happen within the next 60 days. Whereas these other things that are feeling pressing, those won't happen for a while. And a common one is when you have siblings, one sibling saying, okay, where's my check? And being able to set that expectation to say, okay, if we're going through a trust administration process, that sibling very likely is not going to get a check for their inheritance for a while, because things have to happen. So just setting that expectation and taking out the urgency is so powerful. And the last one I would say is, once you've dealt with the emotions, kind of dealt with what's actually urgent, set a good timeline, then to really dream a bit and say, what is my vision? What could this inheritance make possible for us? I think that's a really powerful spot to sit in. And it could be things like retiring early, or it could be things like helping kids get through college. It could be something else entirely. But I think allowing the space to have that vision for yourself and to see where these new assets might fit into, and maybe even open up some opportunities you didn't expect.
Absolutely. Well, to all of our listeners, we hope this was helpful, and thanks so much for tuning in today. I have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordadvisors.com or simply click on the link in the show notes.
We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.